Florida is quietly losing something it once took for granted. Fewer Canadian license plates, empty winter rentals, closed restaurants that once thrived on snowbird season. Nearly 280,000 jobs gone. More than $52 billion erased from a single state economy. And it didn't happen because of a storm, a virus, or a market crash. It happened because of politics, a trade war and a diplomatic breakdown between the United States and Canada triggered one of the fastest tourism collapses in modern U.S. history. This is not just a Florida problem. It's a national warning. What started as aggressive rhetoric, tariff threats, and political posturing turned tourism itself into a pressure point. Canada didn't announce retaliation. Canadians simply stopped coming. And here's what many policymakers still don't grasp. This wasn't a pause, a cycle, or a slowdown. It was a structural break. By the end of this analysis, one overlooked indicator will make clear why Florida may never recover what it lost, even if politics shift. Within a year of trade tensions escalating, Florida experienced a demand shock rarely seen in a developed tourism economy. Airline schedules, labor data, and public tourism figures all tell the same story. The Canadian withdrawal was abrupt, coordinated, and severe. For decades, Canadian visitors injected roughly $38 to $42 billion into Florida every year. Then, almost overnight, that stream collapsed. In a single winter season, arrivals dropped by more than half. In counties built almost entirely around snowbirds, peak winter occupancy plunged more than 40% below historical norms. Coastal towns reported vacancy levels not seen since the financial crisis, even after slashing prices and offering incentives. The job losses came fast. Conservative estimates show 280,000 tourism-linked positions disappearing, from hotels and restaurants to healthcare support, maintenance, real estate, and seasonal services. Internal modeling suggests the real number likely crossed 310,000 once secondary effects are counted. These weren't layoffs waiting to reverse. They were permanent exits. The breaking point wasn't one policy, but alignment. Tariff threats on aluminum, lumber, and agriculture collided with openly hostile political messaging. When Canada was framed publicly as subordinate, the signal resonated. Media coverage intensified. Retirement groups debated alternatives. Consumer behavior shifted. Then border anxiety poured fuel on the fire. Stories of increased screenings, entry denials, and enforcement spread quickly through Canadian network. Whether statistically rare or not didn't matter. For retirees, unpredictability was enough. Travel stopped feeling like leisure and started feeling like risk. Airline data confirmed this wasn't delayed demand. Canadian carriers cut Florida winter capacity by double digits and redeployed aircraft to Europe, Mexico, the Caribbean, and Asia. Those routes filled. Florida didn't rebound. The demand wasn't postponed. It was replaced. Local governments initially blamed inflation and media exaggeration, but the numbers exposed reality. Tourist tax revenue collapsed by up to 50% in some jurisdictions. Infrastructure projects stalled. School budgets were cut. Emergency reserves drained. Florida wasn't riding out a downturn. It was absorbing the consequences of a trade war that converted trust into a fault line. What made the damage far worse than officials admitted is simple. The money didn't disappear. It moved. As Canadian travel to the U.S. declined, spending patterns inside Canada shifted with astonishing speed. Banking flow estimates, airline data, and provincial tourism disclosures show that between $27 and $30 billion per year once spent in Florida was redirected elsewhere within 18 months. No government mandates. No subsidies, just consumer choice. Provinces absorbed the first wave. Winter occupancy rose across Ontario, Quebec, British Columbia, and Atlantic Canada. Retirement housing expanded. Healthcare utilization stabilized. Local service jobs grew. Tax receipts tied to domestic travel surged at levels unseen in decades. What Florida lost became internal Canadian circulation, compounding through wages and public investment. International redirection followed. Canadian Airlines cut Florida-bound seats by more than 30% while expanding routes to Europe, Mexico, and Asia-Pacific. Non-U.S. flights hit record load factors while Florida routes struggled even with discount. Financial markets noticed. Canadian banks and pension funds reduced exposure to U.S. tourism-heavy real estate and increased investment at home and in politically neutral market. In parts of Florida, foreign-owned property listings jumped more than 70% as Canadian owners chose to sell rather than return. Prices softened. Tax bases eroded. Revenue projections were revised downward year after year. For workers, the impact was personal. Service wages stalled. Clinics closed. Healthcare access shrank. Working-age residents began leaving the state, weakening demand even further. What began as a tourism shock became a labor crisis. And the most damaging element is permanence. Surveys across Canadian provinces show most former snowbirds no longer see U.S. travel as predictable or neutral. Even those drawn by weather or cost don't trust the system. Once people restructure healthcare, housing, and social networks elsewhere, they rarely reverse course. Washington misread the vulnerability. Policymakers focused on factories and ports, assuming tourism was discretionary and resilient. In reality, Canadian travel functioned as soft capital, stabilizing labor markets, municipal budgets, healthcare systems, and real estate values. When it withdrew, there was no federal backstop. No stimulus replaces millions of individual decisions not to cross a border. As enforcement perceptions worsened, uncertainty outweighed price. Florida entered a feedback loop. Fewer visitors meant fewer services, lower quality, shorter stays, and reduced spending. Businesses closed. The spiral fed itself. International observers noticed. Allies and investors reassessed exposure to U.S. regions dependent on foreign goodwill. Canada's response was quiet but effective. No embargoes. No speeches. Behavior changed. Domestic tourism strengthened. International diversification accelerated. Capital stayed home. Florida experienced collapse. Canada experienced consolidation. The U.S. didn't lose market share to competitors. It lost it to absence, which is far harder to reverse. Now comes the indicator few discuss publicly. Regional planning models across Florida now assume a permanent shortfall of more than 160,000 seasonal residents each year, driven almost entirely by the disappearance of Canadian snowbird. These projections extend more than 15 years forward. School enrollment forecasts were cut. Healthcare expansions shelved. Transportation demand downgraded. In some coastal counties, projected retiree housing demand fell over 40%. These changes weren't political. They were mathematical. Planners no longer expect Canadians to return in meaningful numbers, regardless of elections or diplomacy. That assumption alone reshapes billions in investment. This marks a deeper failure. The trade war didn't just provoke reaction. It proved allies can disengage silently and cause lasting damage through absence. Canada gained clarity. Spending circulates domestically. Dependence was replaced with options. What was once tradition is now viewed as economic leakage. The lesson Washington hasn't fully absorbed is simple. Power now rests on trust and predictability. When those erode, markets don't protest. They withdraw. Florida didn't lose its winter economy because Canadians were angry. It lost it because Canadians recalculated risk and walked away. This wasn't economic warfare from abroad. It was self-inflicted damage. And the bill is still coming.